how I got into the family office space, it was a bit serendipitous. When I ran my hedge fund in the 90s, they didn't call them family offices. They called them rich people. So I had a bunch of rich people who were clients who are now called family offices. And after I sold my company, I took about a year off and just, traveled and, did some things. And then I started to invest. And my thought process was, when I started the company, it really wasn't a business. It was basically a way for me to get better deal flow and execution. So if I put $1 or $2 million into a direct deal, that might be a lot for an individual, but that's nothing on a cap table. And I'll be the smallest LP at Carlisle or Apollo. So my thought process was, if I could put 1 or 2 million and I could get 98 million or 198 million of family office money, also, now I could take down 100 million or 200 million. Maybe I'll be the first call rather than the 13th call. And it's been very effective. So it's kind of, I call it first call alpha. It doesn't really mean anything other than I made it up. But basically, because I have access to so many family offices and can place a deal fairly quickly, or say no fairly quickly, which is actually equally, if not more important, because people don't want to be held up. If a deal doesn't work, it's not, I will just say, right, it's just not a fit. I don't have to explain myself. And that's much better than having them just hang on. And I think that people do appreciate that. So I started speaking at these conferences. I started doing investments and I started speaking at these conferences, and a lot of the conferences, I'm friends with the people, but it was sort of like, you pay 25 grand and you're now the expert in real estate, and you pay 25,000 and you're the expert in venture capital or private equity. So it's kind of a pay to play model. And when my family is, we work with about 100 family offices, anywhere between 250 million up to 30 billion. And we don't touch anything in the public markets. I think the public markets, where I made my money in the hedge fund world in the 90s, is a very difficult place to make money. I would argue with anybody, I have my money in ETFs in the public markets. It's hard to create alpha. Having said that, and what you guys do in real estate, private equity, venture capital, you certainly can. And real estate represents about 22% of family office money. It's second behind private equity, which is about 24%. Yours is probably going to go up a little bit as hedge fund allocation comes down a little bit, because your performance in general has been really good, you guys and private equity. So I started speaking at these conferences, and I realized that it was kind of fruitless as a pay to play model. And I just came because I would speak. So I wanted to put together something that really made sense for people to go to. So I teach classes at Stanford University, and I'm on the advisory board. And I've been pushing them for about the last 2 years to put together a family office center at Stanford. And about 6 months ago, we got green lighted to go ahead and do it. So basically, the whole point of it is to create an ecosystem with Stanford University to allow family offices to become less fragmented, more efficient, less siloed, and more professional. And what I found through my, decade and a half years working with, they now call them family offices, they didn't back then, is that most of them are fragmented, inefficient, and siloed. So if you guys are sponsors and you guys are really good at real estate, I know Rob's got a great track record, you're really good at real estate, you've got a good deal, doesn't matter what asset class, it could be multifamily, it could be self-storage, it doesn't matter. Realize that the family offices that you're speaking to, they're not necessarily, because they're worth billions of dollars sometimes, there's not a direct correlation between the wealth and how efficient they are. If you think about it, who are these family offices? The guy who sold Beanie Babies, the guy who sold Guess Jeans, Giorgio Armani, Giorgio Perfume, a chain of gas stations, oil wells. So people have these liquidity events, and then they have a capital, but it's a completely different skill set to sell Beanie Babies or 5 Hour Energy, which was fantastic, than it is to take $1 billion, grow it to 2, not spoil the kids, do some wealth transfer, do some estate planning, and grow the assets. So you've got it's a mismatch, very inefficient. And again, I'm generalizing. You've got family offices like the Pritzkers, the Dells, Bloomberg, Sergey Brin. They've institutionalized it, and they can compete directly with Apollo. But when you guys are going out to family offices, understand that they're not going to necessarily know everything you think they're going to probably know. So don't assume that they know everything because they made their money usually in a different area other than real estate. I do think that that you've got you got $10 trillion in capital in family offices. You've got $65 trillion, which is coming downstream from the baby boomers, the next gen in the next 15 years. So this market, the family office market, it's bigger than the private equity and venture capital markets combined. And nobody really knows how to get their hand around it. So advice for you guys, if that's one of the things you'd like me to do, is the family offices, it's all about relationships. So a lot of these, remember, 68% of family offices were started since 2000, and half of those were started since the crash. So this is a new phenomenon, and the model itself doesn't work because only 25% of families make it to G2, 10 make it to G3, and 5 make it to G4. So everyone wants to be a family office. They're inefficient, fragmented, and siloed, and the model doesn't work. And that's what we're trying to create. So I think when you guys are going in, the first, second, and third thing, if you're going to work with a family office, they want to know is not how smart you are, where you went to college, even what your track record is. They need to know they could trust you. The first, second, third thing they would need to know is, can they trust you? The fourth thing is, oh, okay, what's your track record? Tell me about your strategy. And that's flipped because if you look at the pension funds, the first thing they're going to do is say, what's your 3-year, 5-year, 10-year track record? What's your biggest drawdown? They're going to look at the analytics first. Family offices don't. They look at the people. And remember that a lot of these family offices were formed because in 2008, when over half these family offices were formed during the crash, these hedge funds put up things called gates, right? I'm familiar with it because I run a hedge fund. But if you're not, which meant you can't sell. And these people who had money, they thought that people from Wall Street in general were taking advantage of them. So they really lost trust in Wall Street. So the first thing I would tell you is to get into a family office, everybody in this room, I don't know how many people are there, but everybody in this room, I guarantee you knows 1, 2, several different family offices. The best advice I can give is to really get in as close as you can with 1 or 2. And what happens is if you're doing things and adding value, like let's say you're trying to get in bed with a family office and they're looking for this, they like multifamily or they like self-storage or whatever it is. It's not going to happen overnight. Give them a lot of information. Just keep giving without expecting to receive anything in return. And I think when people see that you're giving, that you're like, oh, I know you like self-storage. By the way, this self-storage unit in Tallahassee just sold for 5x, and normally it's 3x. Great. So like you're calling them without selling them anything. So the more touch points you have where you could add value to them without selling, which ultimately is what you want to do, the better. Once you've established a relationship with one, and once they can trust you, I promise you, the best thing they could do, it's much better for me to say that Rob is great than Rob to say that he's great. So third-party endorsements are the best thing you could possibly have. So if you have a family office that can say, hey, you know what, I've worked with Rob before, great guy, busses, young, but he busts his butt, and and I trust him implicitly. They want to share that with other families, and families want to share that, and then it kind of it steamrolls. So I would start by finding 1 or 2, get entrenched with. Don't try to sell them, even if you've got a deal which is the best deal you've ever had, and we all feel that whatever we currently have is the best we've got. Don't. Just have patience with it, and once you have patience with it, and then once you've worked with the family office, and I would also, you're not going to necessarily be dealing with the matriarchs or patriarchs. You're probably going to be dealing with the CIO, the chief investment officer, for many of these family offices. Add value, let them figure out how that you're a giver, not a taker. The biggest turnoff is even if Rob has a deal that is the best he's ever seen by far, and I still wouldn't show that deal yet, because you have to implant the trust, and that's what I really, really emphasize. So a lot of people, everyone's trying to get into, banks are setting up family office divisions. accounting firms are setting up family office divisions, law firm, and a lot of it's just optics. I'm like, what is it? It's just they have the division, they're just calling it family offices because that's where all the money is right now. That's where all the money is going to continue to be. So if all the banks and law firms and accounting firms are trying to set up these family office divisions, and then you have all these people having these conferences for family offices, I think the most important thing to do, if you guys are good at what you do, and I'll take as a given that you are in whatever specific niche you're in real estate, keep showing them things. Even if you're investing yourself, or you have a small fund, and show them quarterly reports, show them what you're doing, any content. People want to see content, what you're writing. I would also, social media, I don't believe in social media in general. There's a lot of problems with, I shouldn't say that. LinkedIn, I think, is a phenomenal platform. But I think the social media, I'm talking about, I've got 17 and 20-year-old daughter. So the Instagram and the TikTok and the Snapchat, whatever, you play with it, do whatever you want. LinkedIn is a very powerful tool. And what's surprising is a lot of people look at LinkedIn. So if you're trying to, again, get in with family offices, write stuff, write content, post things. Rob's phenomenal at this. When he posts something, he's not just showing, look how good I am. He's actually educating people about different things. And people appreciate that. And then when people see him 4, 5, 30, 40 times, they know who he is. And then when he makes a phone call, if he has a deal that he wants to show them, they already know that he's already done a lot of the legwork, and they're going to be able to have a certain level of trust. So I think that if I'm in your shoes and I'm trying to raise money, I think that family offices is definitely the best place to do it. And you guys individually will have to figure out which family office is best for you to kind of get into. And then once you're there, to kind of penetrate that and go further. So that's kind of a 30,000 foot level landscape of, where I think the family offices are. I think that it's numbers. I mean, if it's bigger than the entire private equity and venture capital markets combined, this is a massive market. It's not going away, and it will become more efficient and less siloed. And that's one of the things we're trying to do at Stanford. So I'm happy to answer any questions you have. I wish there was a silver bullet where I could just say, do A, B, and C, and then you'll be in front of 10 family offices. It doesn't work like that, but it does work that if you show value, if you show that they could trust you, and show that you care, and you're not looking just to raise money, but you're looking to add value, you'd be surprised. And then you're in bed with one family office. Getting your second is exponentially easier, and getting your 5th and 10th after that is much, much easier. So that's kind of the way I see the world of family offices. We're trying, at Stanford, the reason we had a conference, it was literally, I had Kirkland and EY, because we do a lot of work with both those firms, sponsor the conference. And I just said, look, you guys sponsor it. It's I'll get you the world-class speakers. We have phenomenal speakers. We have people speaking in your world. We had Tim Callahan, who was Sam Zell's partner, and Lauren Pressman, who spoke from Eric Schmidt's family office on real estate. And we had 880 families. So they're from 6 continents. And this was a virtual Zoom call, and I've never put together one of these things. So I was clueless on how to do it, other than I can get the people. The point of the fact is, it works, and it worked not because of me. It worked because the quality of speakers that we had, that family offices don't want to be sold. And the problem with many of these conferences are the guy next to you is talking to you, but really he's just trying to sell you something. And that model doesn't work. And I think that's why we had, such success with that. And then we're going to have our next family office conference at Stanford. I'll send Rob a link. It's going to be on March 10th. It'll be live. David Rubenstein will be the keynote speaker. And, we'll have some really good speakers. But I would encourage you to go the route of working hard. It does get discouraging from time to time, because, an institution is never going to say, I'm going to Europe for a month and I'll get back to you, right? A family office you're gonna have them say that sometimes, and that does get frustrating. But if you could stick with it, zero question, it's the best way to raise capital. And going forward, 3 to 5 years, it's going to increase exponentially.
Thank you very much for that. That was really cool. I'll kick off with a question, or maybe a couple, which is, you brought up a recurring theme, which I've heard this weekend about third party, reputation, right? It's better to have someone else speak on your behalf than you yourself. And we had a couple private equity firms yesterday speaking, and one was saying something and kind of displaying their understanding about a deal or their conviction about a deal. And then the other said, wow, well, I'd love to piggyback and do a club deal and come in as an LP with you on this deal. And so what's the best way to actually let a partner of yours know that, hey, I like you a lot, but how do you introduce me to your friends, whether it be another PE firm or a family office that, I could potentially work with as well?
Well, it's hard to say, to go up to somebody and say, hey, say something really nice about me, or that I'm really good at what I do. But you could do stuff like that you could do it yourself. So by what you do, Robin, by posting content, value add content that's not selling, which you do a great job of, on LinkedIn. And again, don't underestimate the power of LinkedIn. LinkedIn is in our world and social media, it's as popular and valid for us as it is TikTok for my 17-year-old daughter, who literally lives on her phone. But the third-party endorsements, I'm sure in your everyone in this room has 1, 2, 10 people who think really, really highly of you, who you've done a really good job for. A couple things you could do is, again, this isn't going to be a game changer, but see if you could use them as a reference. Number one, just say, hey, you know what? I know we've worked together for 10 years. We've had a pretty good track record. Would it be okay if I used you as a reference? That reference is going to be better than you telling them how good you are. If that reference is somebody who's got a lot of credibility and he says, hey, Rob is really good, you should listen to him, that's much more powerful than Rob saying, hey, I'm really good and listen to me, right? So that's one thing. Secondly, you could, on LinkedIn and in your social media profile, you could put together people who will say a sentence or 2 sentences about you. I've known Rob for 10 years. He's super honest and, super always, works 14 hours a day, and whatever that is, that's also going to add. So the more people at a higher level that are endorsing you, the better. And you guys may be the best in the world or in your specific niche, but getting the endorsement from somebody else makes a huge difference. If I get a phone call and say, oh, I heard great things about you from so-and-so, well, the next part of the conversation is just really telling them the deal that I'm working on right now. There's no selling involved. So that's why I think it's so important.
Tom, you have a question?
Yeah, I was wondering what you see on the real estate private equity side. Traditionally, you'd see family offices happy to be LPs for slug and maybe on a touch and feel it deal sending. I'm wondering if you're seeing any more appetite for, I like to sponsor more of a blind pool, because that's been hard to do lately. And then lastly, is there any movement towards being really into a deal as like a majority capital partner, really being in the business? You see it going one way or the other? Is it a mixed bag in terms of where the family office will attach?
So really good questions. First, one of the major trends in family office world, and not just in your world in real estate, but has been people want to do direct investments. And why? They want to save money. They don't want to pay the 220, but that's a flawed model. And the problem is that from 2008, so post-crash, pre-COVID, everything worked. So in your world, in real estate, most things went up. In private equity, most things went up. In venture capital, Bitcoin, stock market, everything went up. So these people who did the direct deals, who don't have your skill set in real estate, the negative is that they've already made money. They think it's easier than it really is, and it's not that hard to make money in real estate in the last 8 years, pre-pandemic. So that's what you have going against you. What you have going for you is, most of these family offices, they're just looking, I would position myself as almost an outsourced family outsourced real estate division of a family office, right? So the family office made their money in oil wells, and they're worth $1 billion, and they've got whatever. They could hire 2 or 3 young people, pay them $500,000 a year, and put together a team, but that gets expensive. Or how I would position myself if I'm in your shoes is, look, I only do one thing. I just do real estate, and specifically, I only focus in multifamily, or I only focus in self-storage, or whatever it is. I'll be that outsourced division for you. So if you approach the family office like that, and you explain to them, look, you have 2 options. One, you can hire 2 people just as smart as me. It's going to cost you $500,000 per person to do it. Or you could pay nothing, and I could just show you the deals and tell you what I think. I think that's the best way to do it. And I've seen people do a really good job of positioning themselves as kind of the outsourced real estate arm of the family office. That's not gonna work with a family office that made their money in real estate, because they've already got the experts. But most family offices did not make their money per se in real estate. You've got a lot of people who made their money in technology, and they developed an app and it sold for $1 billion. They're clueless on all the different asset classes, and you could be a huge value add, but position yourself that you're working with them as sort of like a partner rather than trying to sell them something.
And they'd want to be seeing and touching an asset and numbers, as opposed to a little more investing in a sponsor real estate, would you say? That's still
Well, I think so the blind pool, I think it's going to come back. I think as we head into a recession, and we will, I mean, look, the last 8 years, pre-pandemic, everything went up, but the world doesn't work like that. Everything goes, the market's cyclical. So as things come down, I think that's when you guys are going to really be called on, because when the market gets down, people will realize, well, maybe these direct investments, maybe this multifamily deal that I did and I made a lot of money, maybe there's I had some tailwinds, or maybe there's a little luck involved, or maybe everything in Florida went up and it's not that I'm that smart. That's when it's going to be people like you who are going to really add a lot of value, because I think they're going to come back to, I don't mind paying $220, because at the end of the day, by paying $220, I tell people, when they ask me that question, I said, look, would you rather pay $110 and lose money, or pay $220? And I just dumb it down, and it does make sense. So if I've got a heart condition, I'm not going to try to find the cheapest doctor. I'm going to try to find the absolute best doctor. So I think people will be concerned less about the fees. And the 220 model, it does work, and it is aligned. The problem that the family offices have is not going to be at your guys' level. It's the multi-billion-dollar funds, because they've bastardized the business, and it's become an AUM game. So what, private equity and venture capital disrupted the public markets in the early 80s because it was a better model. 2% covers the overhead, 20%, I only make money if you make money. That's a better model than reporting to a guy like me every 90 days to see how earnings are. None of you could grow your company if every 90 days you'd report to me and I told, and you'd explain how you're doing. You couldn't make investments, you couldn't do things. The problem is the private equity and venture capital real estate industry, they bastardized the business, and they realized, and again, I'm generalizing, but the 2% became an annuity, and that's every single year. So on $2 billion, 2%, it's a 10-year fund. That's a lot of recurring revenue, irrespective of how you do. So I had a guy did a roll-up of logistics companies, great track record, and he needed 150 million. There's a niche strategy in the Northeast, and the placement agent came to him and said, I shopped it around. We were able to get 500 million, and the guy's like, terrific. We need 150, and we're getting started. Placement agent literally came to his house, their apartment in New York City, and wrote down 2% of 500 million equals X, 2% of 150 million equals Y. What am I missing? And my friend is incredulous. He looks at her and she goes, if I do what you want me to do, there won't be a fund two. Because yes, I can make more money today by doing what you're suggesting. but I can't place 500 million. I can only place 150 for this strategy. And then I've got to do not just A deals, which is what I should be doing, but I have to do B and C deals. And the performance isn't going to be good. And then I'm not going to have a fund too. So I always try to look at things from a 5-year lens, like how is this going to play out in 5 years? And that's the biggest problem that people have with the blind pool is it's not you guys, it's just a $25 billion fund. There's not a direct correlation. There's almost an inverse correlation. If you have that much money and you have to place it, that's not a good place to be. And there was a good friend of mine, Michael Loeb, who's founder of Priceline and a few other large companies. He was meeting with the head of SoftBank one day, and there was a company that they had called Branded. It's irrelevant what they did. And they asked him, they just paid $250 million. And they said, what do you think? They just asked, because it was a direct to consumer business. And he's a New Yorker. He's like, well, I think it didn't make sense and you way overpaid, but I'm sure you know more than I do. So why'd you buy it? And apparently the reason they bought it was, SoftBank has $100 billion, right? So $250 million is 25 basis points. It was a woman-owned company, and he could be wrong. So the thought process is, look, it's a woman-owned company. We want to bring in business, and I might be wrong. I also agree it's going to probably be a bad investment. So think about the mentality of that. So the problem is, and the point I'm trying to make is, there's so much money out there right now. There are not enough companies. So a lot in your world in real estate, if it's a niche business, if there's a certain segment that you're going after, you don't want to be in a position where you've got $500 million and realistically you can only deploy 200, or I'm making up numbers, but you can only deploy a certain part of that to be more efficient. So focus on that, focus on the returns. And I think that the model, look, in real estate, it'll never go away. That's where many of these, most of the families, if they have a liquidity event, the thing they want to do is make their money in real estate. These technology, yeah, you're going to have the tech companies are going to grow exponentially, and you're going to have somebody create DocuSign, and I work with the guy who created DocuSign, but in all these apps. But at the end of the day, real estate's something tangible that you could touch. Everybody knows it, and most people who have a lot of money have real estate in their portfolio, and will continue to.
So Ron, where do family offices hang out aside from conferences? Where do they hang out, and where do they summer?
Where do they summer? Yeah, that would be a good idea. I can get you some addresses. So I think that, and again, I know it's a bit of a rhetorical question, but it's really also a really good question. The other thing is, family offices, most of them are very philanthropic, not all, but many of them are very philanthropic. Some very, some somewhat. So whatever causes you're into, and you need to be authentic. So if you're into climate problems, or you're into poverty or education, whatever it is, get involved in some charities. The family offices, the very wealthy people, they're there. And if you're working with a family office and your goal on that charity is to help save the climate, or help educate, or stop gun violence, or whatever it's important to you guys, you've got a different relationship now. You're now working with them. You're not just trying to sell them something, right? If you haven't been working with them on that charity. So I would say, one, be authentic, but whatever causes are important to you, get involved in a couple philanthropies and charities, because that's where there's a lot of people. I think that the conferences in general, personally, I think they're a waste of time now. And again, I'm generalizing. You'll meet one or two. It's mostly service providers speaking to other service providers, and there's just a couple family offices who actually attend these events. So I think that getting involved in a few different philanthropies and charities that's important to you. Don't get involved in climate if that's not your thing, because you need to be authentic with it. But people appreciate, and again, a lot of the people in this room are, I'm looking at the front, you're young. People appreciate, just be authentic. I mean, the more authentic you are, and the more believable you are, the more likely they are to work with you. You don't have to have, not everyone in this room has the best track record in every single asset class. You can't. But if people knew that I don't, I might not have the best, all I can tell you is I've done multifamily for 20 years or 10 years, and not every deal's worked out, but I've busted my butt. And if you talk to my clients, they will tell you what happens during the downtimes. I'm communicating with them more and more. And that's important. So it's the whole business of what you're trying to do. It's all about relationships. That's it. It's not anything more than that. And intuitively, you'll think, well, shit, I've got a 30% IRR track record in the last. It's not irrelevant, but that's not the most relevant. The most relevant is be authentic and be somebody that they can trust. And then you'll be able to get in the door and hopefully do more deals with them. And then once you get in with one, you get in with two, and you get in with five.
Can you rely on
Family offices.
introductions, advisories, familyoffice.com type of situations to meet family offices?
No.
That's clear cut answer. Thank you.
Good question.
Yeah.
What advice would you give to a younger entrepreneur who has strong relationships with other younger professionals who work in family offices? For example, an associate or someone who's worked their way
Right.
up to manager.
Right. And again, your friends who work for these other family offices, developing authentic, not you're friends with them because they work for family office, you're friends with them because you like hanging out with them. That's going to be really key. And remember, you've got $65 trillion that's being transferred from the baby boomers to your generation in the next 15 years. So the next gen, the 20s and 30s, I call them kids, but the people who are in their 20s and 30s, they're going to be the decision makers, right? And you're young, many people in this room are young, you're going to grow with them. And, I just think that by being with them, by finding out what they invest in, finding out, I know they like multifamily in the Southeast because that's where all the growth is, and they really like Florida. Any article you see from Barron's or you read something from Bloomberg or you read, just forward it to them. Just thinking about you, I know you're really into real estate and whatever, just thought this would be interesting. It's shocking how few people do it. And the other thing is, like, if I say, hey, I'll introduce you to so-and-so, do it. I mean, the biggest value add you guys can give is to introduce families to other families. So if you've got 2 or 3 friends who work for family offices, introduce them to other family offices, because that's really the best thing you can do for them. And that's adding a lot of value. You're not selling anything. You're just saying, hey, I know Rob, my friend Rob works for a family office, and I want to introduce you to Bob, who also works for a family office. You two should get together, and I'm out of the loop. I just think it's value add. By doing stuff like that, by going out and giving rather than taking, which is kind of, our society is very myopic, right? We want things right away. But by going out and giving, you will get back 10 times in return. I promise you. And I don't know, I can't tell you how it's going to play out, but the dots will be connected to do that. And so I would just say, continue to network, continue to hang out with those people, assuming that these are friends and you're hanging out for the right reasons. Because then it's easy. Then you just pick up the phone and say, hey, Rob, I just want to show you something. I just saw something this is a really good deal. Well, if you're a friend with that person, you're not calling them every day with that, right? You're calling them once a year, once every whatever. When you see something, it's authentic, they'll look at it and you'll develop relationships. But it's all about developing relationships.
Thank you.
How
how would you say we should manage the relationship between the sponsors and the family office outside of the realm of the real estate investment? So, for example, we like to send for the holidays. We like to send like a fruit platter where the family stays. We got very good feedback on this. So if you have any other idea on different values, because not everyone has the charisma of Rob to stand in front of the camera and speak.
Yeah, no, it's a great question. And again, a lot of the touch points when you have are not just the transaction, right? So we'll start with your goal is to try to raise money from these wealthy family offices so you can invest in your expertise. So that's kind of your goal. But the soft stuff, like I run a couple of Tiger 21 groups in Chicago. It's fairly big in New York. And one of the things I would say is, yes, it's nice to have a fruit basket. I don't know how many LPs you have, but if you're dealing with these family offices, they're not that many. I mean, you're not going to be working with hundreds of you're going to be working with 4 or 8. You ever send anybody a handwritten note? I send handwritten notes to all the people. I have my wife write it because she's got better penmanship, but I send handwritten notes. You tell me the last time you've got something in the mail that you're looking forward to. Never. It's always a bill or sort of junk mail. By doing something handwritten, it's just showing that you're care. I was like, when I started out, I mean, when I ran my hedge fund, I was 28, I think 29 when I started it, and I was competing against a guy who was much more qualified than me and just had a much bit longer track record because he was twice my age, and he had done quite well. But when I was trying to present to this family office, they were rich people back then, and when he was trying to present to it, he just came back with all these statistics, and I came back and I just authentically wrote, look, I know I'm only 29 and I can't do anything about that, and I can't do anything about and the other person I'm sure is terrific, but here's why it's so important for me and why I think I think I could earn your business. And I just wrote, and I don't even remember what I wrote, but he told me the reason he went with me is because I wrote that 2-page letter. So again, the fact that people think you're going above and beyond, and again, going to Harry and David's and giving everyone the same fruit basket, that's not what I'm talking about. I'm talking about doing something. If you know this family office, they love sailing, right? You don't have to spend a ton of money, but if you're in Newport, Rhode Island, and you take a picture of a couple photos of, I know you love sailing, and I'm at the museum, the National Sailing Museum, thought you might enjoy this. Just stuff like that shows you're thinking about them makes a huge difference. That's going to be the differentiator. It's not whether your return is 13% versus 15%, and they're going to necessarily go with the guy who has 15%. I would go with the guy who has 13% and I trust implicitly and I know has my back, versus the guy who's got a little better track record. My accountant, I'll give you a perfect example. My accountant gets more stressed out than I do when I'm getting close to the deadline to be late for to pay my taxes. He's freaking out. I want to work with that guy. It impacts me. It doesn't impact him, but he's so freaked out that I'm going to potentially be late and pay a penalty that he's like, Ron, we got to do this. We got to get this done. And he gets stressed out. I want to work with that guy. He cares, and he'll be my accountant for life. So things like that matter, and also put yourself in the other person's shoes. Because look, at the end of the day, these are just, most of the people you're dealing with, they're not like the Rockefellers and the Vanderbilts, the Carnegies. They're like multi-generation family. I mean, some are, but most of them are not. Most of them they've had a liquidity event in the last 10, 20 years, maybe 30. And they're just people. They're just like you guys. They're no different. And I think that, even a little thing like if somebody's cause is, prostate, my dad passed from prostate cancer at a very young age. So if you know that somebody's cause, donate $25. It doesn't say the amount you're donating, but just this person was donated $25 on behalf of so-and-so. It's just a question of being thoughtful. And it's almost like you have to take the mentality that's instilled in us on Wall Street, where it's like, AUM, get the assets management, go a little bit slower, which is sometimes harder, particularly for the younger people. But by slowing down, you're going to jump ahead several steps. And one of the things I remember, I was at a speech, Jeff Bezos gave a speech, and he had talked about, everyone tells me how brilliant I am. And yeah, he actually is brilliant. But he goes, the reason I've been successful is that I compete on my time frame. I have patient capital, right? So my time frame is larger. So if everybody that I'm competing with has a 3 to 5 year time frame, and I've got a 10-year time frame, I'm going to do better. Period. End of conversation. And if you look at things like space, right? Nobody's going to make money in space today. Who's doing space? The multi-billionaires who could afford to do it, and they could be patient. And maybe in 15 or 20 years, Elon Musk will make a lot of money, or maybe the guy, Richard Branson, will make a lot of money in it. But they've got patient capital. So I think that the main thing people want to know is, are your interests aligned with theirs? And that's really it. And you could have, you might have a bad year. Let's say you have a 220 fund and you had an off year, and it was nothing to do with you. It had to do with a pandemic that happened in Wuhan, China. I mean, that's nobody's fault. You know what? This year, I certainly didn't cause a pandemic, but this year I'm going to waive the management fee, or I'm going to cut it in half, or just little things like that. So when they're down and everyone's portfolio is going to go down a little bit, you're basically saying to them, you know what? I know I'm a steward of your capital, and it wasn't my fault, but we had an off year, so I'm going to take a little bit less. Little things like that, and it doesn't have to be no management fee. It doesn't even have to be 1%. You could take 25 basis points or 50 or whatever you want to do. But it's all about alignment of interest. And if they know that they trust you and you care, it comes through. I mean, you guys in the room, people who are full of shit, and you also know people who are truly authentic. And the people that are authentic are people that you want to work with. And by presenting yourself as the guru in this, and again, you may be, but you want to position yourself as somebody that's authentic and they could trust, more so than, I know more about multifamily than anyone in the country. That's what I would say.
We've got time for one more question.
Hey, Ron, thanks for the presentation. You mentioned that family offices will pick up as a source of capital over the next 3 or 4 years. I'm wondering, what do you think is driving that? And how can we take advantage of that trend as we build relationships with these offices?
Well, yeah, the statistics are that there's 17,000 family offices roughly in the world. There's $10 trillion in capital roughly, and there's 65 trillion that's coming downstream in the next 15 years. Largest transfer of wealth in the history of the world. So next 15 years is going to be a boom for the family offices. Just getting in front of them, and again, just sending articles, sending things that are value add. It's not going to happen overnight, and I know you'd prefer me to give you a silver bullet and say, you do A, B, and C, and then you'll get in the door with family offices. But I could just tell you that how I did it. And again, I didn't have a blueprint, right? So I didn't write I had no idea by writing this 2-page note. And I really did care, because this would have been it was my biggest client at the time. I really cared to get that client. And he could tell that I cared, because I spent a couple hours writing a 2-page handwritten letter. And that's why he went to me. Somebody's kid has special needs, cerebral palsy, whatever it is, you're donating something. It doesn't have to be a huge dollar amount. This is a gift on behalf of whatever. Get involved in charities that they're involved in. And the more touch points you have with families when you're not selling, the better. So that when you do sell, when you do have something to sell, they're like, they've already known you for 10 other times, when you work with them, when they've seen you at charity events, when they've seen you at dinners, when they've seen you at ball games. And now you're saying, I got a good deal I want to show you. That's the time to do it, not at the beginning.
Thanks.
Thank you so much, Ron, for joining us. I really actually learned a lot, and it was very actionable. I haven't heard so many good things that I could just write down, and handwritten notes, philanthropy, be the outsourced real estate arm of the family office. So those are things that I'm going to do actually right away.
Well, again, I look, it's great. I wish I could be there in person. But it's great meeting all you, Rob. Continue doing what you're doing. Rob does a tremendous job. And again, 90, I mean, maybe even 100% of what he does, he's not making money when he posts these things on LinkedIn and does what this conference. He's adding value, and at some point, by adding value, people will see that, and then maybe he will have a deal that he will want to show to some people. So I think what Rob's doing is like a great example of how I would do it if I'm in your guys' shoes.
Thank you very much. All right. Thanks, guys. Let's give them a hand.